Well, this week, we're going to be talking about another aspect of passive investing, probably the most important factor to consider before you invest in any passive investments is the sponsor. I'm joined by the GOAT. I call her the GOAT of Dallas multifamily real estate. She's an absolute rock star when it comes to operating multifamily real estate. She's also runs a mastermind group called ACE Operations, which is a mastermind specifically designed for multifamily real estate operators. And she teaches them how to operate properties efficiently, how to take care of lenders, how to satisfy lenders, how to satisfy brokers, etc. She's really adept at operating through difficult times like she did through COVID. And I'm really excited to have her here. Let me bring on our guest, Sandhya Seshadri, everyone.
Thank you so much, Jonny.
Yes. We've become very good friends. She's also helped me and taught me a lot about the operational side of multifamily real estate. We've hung out in Cabo. We've hung out in, where else? New Orleans. We've hung out in, I think, LA, Manhattan Beach. And then just recently, we were, where was that? Where
Phoenix.
In where?
Phoenix.
In Phoenix, yes, Phoenix. I've been all over the place lately, so I can't even remember all these conferences. But absolutely, thank you for being here, Sandia. I'm a very big fan of yours and everything that you're doing, and so I really appreciate you being here. So listen, why don't we get right into our topic today? First, I'll give you a minute or two to introduce yourself, what you focus on in your business. I kind of already alluded to it a little bit, and what you have, what are you looking to do moving forward? Please.
Hi, thank you so much for having me, Jonny. I'm Sandia, based in Dallas, and like most Asian geeks, started out as an engineer, had a full-time engineering career, got my MBA, traded stocks, had kids, and then got into full-time multifamily syndications now, which is where we get other people's money to go buy large properties. So we have economies of scale. Instead of me trying to do my own single family, you doing your own single family, etc. So we have the economies of scale for efficient operations. And so my mastermind is called ACE Operators. It's only for people who are general partners and involved in the asset management aspects. So it's through an application process, about 86 applications so far, and I took about 21 people. So, it is by, making sure it's a mastermind so everyone adds value. But I'm focused on DFW as my market because I've lived here for 33 years. And so I buy value add multifamily, which is Class B and Class C, meaning they were built in the 70s, 80s or so. They're not brand new buildings that were acquired in the last few years, but we like to buy slightly older properties and then renovate them to look almost half as nice as brand new properties. And they cost a lot less, and it's for affordable housing, and it's for tenants who make, 50, 60, 70K median household income.
Very dialed in, very, very specific. I really love that. And so you choose to, we've seen other operators that focus on multiple markets. You're very focused only on one market. Why is that?
Because it's the market that I know best, and the market is still doing well. The biggest macro factors that you probably talked about with Zach, and look, somebody with over $1 billion of assets under management in Phoenix has chosen Dallas as his second choice. So that should be enough from last week's conversation. But for me, it's the diversity of jobs. It's the fact that we're not dependent on just one industry. It's the population migration patterns. It's the fact that our rents don't, continue to appreciate. Even today, I have not had to lower my rents. There might be a lot of construction happening of brand new apartments, but it doesn't really affect my Class B and Class C, which is my older properties. Maybe some of the properties acquired built in the last 5 years could be affected by it, but it doesn't affect me. And I have personal knowledge. I know about 1,000 different people who own apartments in the Dallas area. So if I was looking at a brand new property, I would immediately be able to say what the rents should be, what the expenses should be from actual data of those people, rather than buying some report. So that's my competitive advantage. I can go visit all my properties, or within a 30-minute drive of my house, I can check on them as often as I want. It's closer for me to go to my properties than the airport. It's kind of like that. And so that's why that's my, sweet spot. But if the market doesn't behave the way it has been in the last few years, there's always room to go explore a new market. But so far, that hasn't been the case. Also, I'm focusing on operations right now. So I'm not really looking at new acquisitions for the next 30 days because I want to get a couple of deals refinanced before taxes hit us mid-April.
Very smart. And so, from what I gather from what you focus there, you live there, you're a local expert in that market, right? You know the streets, you know the neighborhoods.
Yep.
Just from the name of the neighborhood, I know what the rent should be in that neighborhood for an apartment building. You have a very good ballpark idea. You have excellent relationships with brokers, service people, you have construction people. I'm sure you have a whole plethora of people that you can reach out and talk to and have the expertise. And that's what us as a passive investor, as you know, this is a group of dentists that are looking to achieve financial freedom through passive investment. And so we are really like to, in this group, what we're really trying to hone in on is how can we invest in a predictable way that we reduce the chances of losing money. Number one, capital preservation. And number two, how can we improve our life with income and building our wealth so that we can become less dependent on dentistry? So with that being said, from the perspective of passive investor, I'd like to take this discussion. I know that you're a general partner, but you also are a syndicator, so that you take on passive investors in your deals and you participate in other people's deals as a passive investor as well.
Mhm.
So today we're going to talk about the top 5 criteria for choosing a sponsor in a passive investment, right? So before we do that, I mean, let's dive into it a little bit. I mean, in a passive investment, what is the single most important factor? Would it be the building that you're buying? Would it be where you're buying? Or would it be who's going to be operating the property?
So the most important criteria for me is who's going to be operating the property, because they could be a very good deal in an excellent location, but the wrong operator can ruin it. But a very close second is the location itself, because real estate is still all about location.
Okay, very good. So last week we covered how to choose a location. So today we're going to talk about how to choose a sponsor as a passive investor. All right, so let's get right into it, Sandhya. So not in any particular order. I mean, if you have it in some type of order, we could go from 5. Start from 5, 4, 3, 2, 1, and start with the most important, or we go whichever way you want to go. But give me one criteria, that one of the top criteria that we need to consider as a passive investor.
If I was choosing a surgeon for brain surgery, do I want a fresh graduate, or do I want an experienced surgeon in the room? I treat my $50K investment in a passive deal the same way. So experience and track record in that local market, in that asset class. So I'm expert in Dallas. If I suddenly go to a new market, you want to ask me, who am I partnering with? Who has that local expertise? If I suddenly go to Kansas City or North Carolina, that's the question you should be asking me: is who's your local expert there that is helping you?
So you are going to really look at the experience of the principal within the market, whatever the deal is. What experience? What experience do you have operating this type of asset class? And then the other thing you said, not just experience and track record, but also in that specific niche, right? Like,
correct. Like, I'm in Dallas doing apartments, but if I start doing self-storage or mobile home parks, you should ask me, well, where do you have that experience, or who's in your team with that experience?
Right. Because if I'm like, hey, look, Sandia, I just trust you, Sandia. So if you're doing multifamily real estate and you're going to do mobile home parks, I shouldn't necessarily assume that your expertise and skill sets are going to automatically translate to another asset class.
Correct, because the way you underwrite them are different, the market cycles are different, the tenant base is different, etc. So
yeah, I love that you said that, because there are operators that will jump from, hey, look, I got this deal, it's a mobile home park, I got this assisted living deal also. And these people, sometimes they're really smart, they're really, and not to take away from that, but just when you look at overall, I want to have somebody, like you said, a brain surgeon that has done 1,000 surgeries.
Yep.
Not the first guy out of residency, and now this is our first patient out of residency. Even if that person is very gifted and very great surgeon, I still want him to go out and work on several more people's brains before he works on my brain, right? If he's a brain surgeon.
Or I want that expert in the room. I want the lead brain surgeon, head of surgery in that room with him to catch a mistake, because I know everybody has to learn. So my first deal, I partnered with people who had more experience than me, so that we didn't make a mistake. And that was first deal was a home run. And that's how you want it to be.
Love it. Love it. All right. Number 2, what would be the next criteria that we would discuss here?
Their existing assets should already be in that location, so that the numbers they put into all these spreadsheets is real, actual data. So that it's not just I'm paying for a CoStar report and I'm taking rent numbers from there. They should already have the presence to know what numbers are achievable and realistic for that market, because taxes are a big deal in Texas. Insurance could go up if you're in a coastal area or in Houston, but those might not be important factors if you're in Phoenix. Taxes don't really matter in Phoenix as much, right, as they do in Texas. So the nuances associated with that, they should currently have existing assets of that class, or they should be getting their numbers from somebody else with those assets right there. So it's the assumptions in the underwriting need to be validated with actual data and neutral inputs. Who is neutral? For taxes, I have a tax protest company. For insurance, I get an insurance quote from a broker who's got properties that are insured by that same carrier in that area. They're not newbies coming into the Texas market. They're already insuring properties in Texas. So I know their numbers will be accurate. Where would my expenses and sources of income come from? A property management company that's already running properties for me in that area. So those numbers make sense. Oh, I think I'm going to charge $100 for parking. Okay, this renter barely makes $60K a year. Then I'm going to pay $100 more for parking. So where did that number come from? So somebody else who's neutral is going to validate that. So you're not tempted to put all these numbers in your spreadsheet to make the return seem amazing so you can raise capital. So assumptions would be the second most important point, validated by actual data in that market.
So that's a great point, right? Assumptions. Now that's, and there's too many of us dentists, right? Like when we are looking at a passive investment, one of the most important criteria that we look at, and this may be wrong, actually, in my opinion, it is wrong to be the main thing that you're looking at, is the IRR. Hey, this one has a projected 22% IRR. This one only has a projected IRR of 16%. So because of that, I'm going to invest in the one that has a 22% IRR.
And as an engineer who's familiar with spreadsheets, I'm going to tell you, all I got to do is tweak 2 numbers, maybe 1 number, and I can change it from 16 to 22 in the blink of an eyelid.
Yep.
So that's why you got to, who do you trust to make the right assumptions, and where did those assumption numbers come from? Like exit cap rate. This may sound a little deep, but it's an example of saying, what do you think the interest rates and cap rates will be in 5 years when I'm ready to sell this asset, right? And so that you can predict that nobody's right in their predictions of interest rates and cap rates. It's totally speculative. But that number, if I make it 5 or 6 or 7, it completely alters the returns. So how do you make that assumption? And the criteria I have for that is your exit cap rate or interest rate that you're assuming in 5 years. You assume it to be greater than what it is today. So if you're buying the deal today on a 5 or 6 cap, assume it at a 7 cap, right? If you're buying it on a 4 cap, assume a 5.5 cap, something like that.
So, that's a very interesting point, right? And this, because you could take the exact same deal. You could take the exact same building. Let's say it's a 300 unit apartment building. I underwrite it and you underwrite it.
Yep.
Right? I underwrite it and I get a 25% IRR. You underwrite the very same property and get a 16% IRR.
That's right.
Property.
Yep.
Right? And you can't base your decisions on IRR because IRR is basically a guess into the future, right? Predicting what's going to happen in the future.
The exit cap rate is a prediction of the future. The IRR is a calculation on your spreadsheet based on the input you put into it.
And the exit cap is a very sensitive number, right? So a lot of people now are even and you said, and like you just mentioned that, hey, look, if I buy it at a 5 cap, I'm looking at my exit cap rate at 6. There's a lot of operators in today's day that are giving, they're reducing their exit cap rate by 10 basis points a year because they say, hey, interest rates are going to be going down. Cap rates, we predict cap rates are also going to compress. And as a result, we're buying at a 5 and we're going to show our exit cap at a 4.5%. And that is going to show incredible returns.
Yep, that one metric will show incredible returns.
Accurate or not, right? And Sandia will take that same property and buy it at a 5 cap rate and have a reversion cap rate of 6.
Yep, I will.
Versus somebody that's going the other way, and they're going to show vastly different numbers.
Yep.
For the same deal.
Exactly.
So it's very important to understand those assumptions. And now some of the other assumptions that you talked about is that you talked about CoStar, right? And CoStar, what is CoStar exactly for people that are listening and might not know what that is?
It's a source of data for you to know all the rents in that subdivision so that you can say that my competitors are charging $1,500 for a 2-bedroom. I'm only charging $1,300. So look at this upside. So CoStar is a data source that's used by brokers to sell you or show you why there's a huge upside potential in this subject property. And you might be subscribing to that CoStar report so that you can plug the data from the competitors around to make predictions on what you think your rent is going to be at this property. And they say it's a very good report. But what about actual numbers? If you knew people who ran properties near you and had those actual numbers, that's even more powerful. Or if you just went to the websites of those properties, right? If you know physically the property's location, you looked up within a 5-mile radius or 1-mile radius, the properties that are competitors that your renter is going to choose. Instead of your subject property, I'm going to go down the street to this property XYZ instead. And if you could look at those websites or even call them up, then you have actual data of today's rents.
More
accurate data rather than CoStar, which may have published it 6 months ago or whatever else, and you may not have the most accurate numbers. But that rent assumption is huge, right? That's your bread and butter for your multifamily. So if you think you're going to get that $300 rent from doing something, when in fact, realistically, it's maybe $100, hey, that's a big difference.
So listen, Sandhya, if I'm a dentist, right, and I'm like, hey, look, I'm looking at this deal. Sandhya's showing this IRR of 18%. And I remember her saying that you've got to look at the assumptions. How does a passive investor navigate that? How do they know if your assumptions are conservative, they're aggressive, or is this something that, how would you know, right? If you're a passive investor, how would you know if the data is accurate? And like how would a dentist that's looking at a deal know this, right? Like, is there a way to know this without just going and doing the research yourself and going into CoStar yourself?
You can go to websites yourself, but a realistic one is if you don't have access to somebody like Jonny, who's got a whole pack of, 15, 20 other fund managers looking at this, and you're this lone dentist and you come across a sponsor like me making some claims on these rents, the easiest way for you to ask is, okay, how many other properties do you own in that area or do you manage in that area? And so then you'll know that's realistic. Is this the rents you're getting? Are they similar kind of properties? Because Class A, which was built in the last 5 years, is not a fair comparison to a Class C built in the 70s. So you want to know if they have experience in that local area, and where is the source of their data. Did the property management company who's going to run this property for them agree to the numbers? That's what you want to ask them. Who's going to manage this? Oh, your own property management company, or you're hiring a third party? Did they agree to these numbers? Did they agree to your business plan? Did they say that if you put granite countertops and stainless steel appliances, you can get $200 more? Did they agree that you can get $25 for charging for parking? Did they agree that you can get $50 for washer and dryer? So all those expense and income numbers should be validated by a local PM company running properties in that area. Or if you're vertically integrated, which is great, like, Rise 48, you should have other properties in the area for comparison.
When you say PM, just
property management company, sorry.
Management, right? So, and just for clarification, there's two ways to manage these properties, right? One is you have an in-house management company where you you create your own company and have them run it for you, or you can hire a third-party property manager that specializes in running those type of assets, right? Like a large multifamily, something like that in Dallas, right?
And there's plus and minus to both.
Yep.
And the only challenge I will give you is I've had property managements that doesn't perform in the past, so I've been able to fire them. If they're in-house, will I fire myself? It's a good question.
good, fair.
I mean, like
both. I agree with that, and I think that's a whole other video or episode in itself. All right, so next point. This is great. This is great information. If anybody's getting value from this, and you're enjoying it all, if you're getting any value from this, drop a fire emoji in the chat right now, please, and let's support our guests that are visiting us today. All right, Sandhya. So next, let's talk about the next point. What's the third criteria on choosing the right sponsor?
Are they a team that has worked well together before? Or is it the first time three random people are getting together, LA, New York, and Dallas are all getting together. They've never worked on a deal before. Because you want to make sure the partnership team works together well, cohesively. Because what happens is when new teams are formed, they're still figuring themselves out. They're not all aligned on the same priorities. So you want to make sure of that. And you want to make sure each of those partners is putting a lot of money into the deal. Because if they're too skinny, right? Let's say they're putting $50K into the deal, but then they're taking an acquisition fee of $100K. They just walked away from the deal at the closing plus $50K positive. So if the deal financially doesn't perform, they don't lose any money. They are not affected financially by the deal at all. So I want to know how much skin in the game they have, each of the partners involved, or is it just a moneymaker for them?
Yeah, that's a great point. That's a very great point. So before we expand on that, just want to give a shout out to some of the people here. Dr. Anthony Prezisio, he says vertical companies can abuse fees they charge. Example, renovations, overruns, and destroy returns. Shout out to my girl, Dr. Ivory Hancock from Washington, D.C. She says, hello. She dropped a fire emoji. So thank you for that. Thank you for being here, Ivory. All right. So Sandhya, from what you just said, again, the same thing, same question, right? As a passive investor, what kind of questions are you asking? How do you know that this team works together? Like what kind of probing questions or insightful questions could you ask the sponsor? And most likely, if it's a large sponsor, you're talking to somebody in investor relations. How do you address that? What kind of questions would you ask?
I expect the webinar slides to show me the team, the full team of every person involved in a decision-making capacity in the deal. Mm-hmm. So then let's say they put, Tom, Dick, and Harry. I don't know if the three of them have worked together before, or only Tom and Harry, but not, the other person, right? So you want to know if the 3 people or 4 people who you see as the main leads have worked well together, and if they have complementary strengths. So that one can cover a different topic versus the other. Like I'm always the local boots on the ground with local market knowledge and always available to run through the properties at the first sign of a problem. I have partners who are experienced, I have one partner who's an accountant. I have one partner who's been in insurance in his past life, right? So their roles, what they're going to be. Like the accountant is the one who's going to do all the financial audits, going to take care of taxes and K1s and all of that, versus the insurance person is going to be the one who reviews our policy and is more detail oriented, reads the fine print, etc. So typically lender, legal, insurance, he's the main person for that. So you accordingly find, and then there's the one who's got the bubbly personality and likes to talk to a lot of people and investors, right? And that's your outgoing person, like Johnny, Dr. Johnny Walker type of personality. So you make sure you cover all the bases, because you don't want everybody to be an engineering geek, geeking out on underwriting spreadsheets, but having no clue how to deal with insurance or, the lender finance, etc.
Yeah, that's a great point. So you want to look at those keys. So when you're looking at the investor deck, right? So when we're looking at a passive investment, we all get a presentation, and it's going to list out the key principles, right? The main people, the decision makers, as you said, in that company. Now, just by them saying, hey, I've been in real estate for 30 years, I've been in it for 25 years, that's not enough, right? You got to look into it a little deeper. And do these people have complementary skills, right? Like you said, one person. So in multifamily real estate is a team game, and each player has their roles. Each of them should have specific skill sets for each role. Right? Like if you're an accountant, you're probably going to be looking at the numbers. Maybe you're really good at underwriting, and you're geek out on spreadsheets because that's where the world that you live in. But you, like you said, you don't want to have 2 or 3 people that are that person. You need another person that is boots on the ground. And when we say boots on the ground, there's somebody that actually is there at the property, making sure property management is doing what they got to do, is excellent in knowing about renovations and can manage construction of projects that are CapEx projects that are happening at the deal. So having complementary skill sets amongst the key principles is paramount for running a property efficiently. Okay, I love it, Sandia.
And I want to touch on the point you just said, which is people have resumes that say, I've been in real estate for over 20 years and I know this. Well, they might have done only single family, and it might have only involved their own money. It's very different when you're a syndicator. So I say, how long have you been responsible for other people's money? Do you know what that's like to be up every night knowing millions of dollars of other people's money is riding on your management of this asset? That's a completely different feeling than if I keep accumulating real estate slowly, buying a single and a quadplex and so on, That's not the same. So I like to know that, and I like to know about the skin of the game. The other thing I like to ask is, just like if I'm going to hire a contractor, let's say I want to remodel my kitchen and it's going to cost me roughly $50,000, which is typically the minimum investment in these deals. Am I just going to hire somebody because I saw them advertised on, I don't know, Google Pages or something from the local area? What am I going to do? I'm going to first ask a friend, neighbor for recommendations, someone I trust, someone for whom this contractor has done a similar job before. So I always ask for references from passive investors, not about somebody like Jonny, because Jonny is sort of like he's a fundraiser middle person, but he's not the one actually operating the asset afterwards. So I want to do my homework of reference from passive investors, of the main person who's going to be running the asset after it closes. And, when you have a group like what Jonny has, they do that due diligence for you. But if you just get an email from some random person, how do you know if they've actually delivered the projections they claim? Maybe they're telling you, guess what? I've delivered IRRs of, 50% or something. Okay. Show me 5 passive investors and what the name of those deals are. When did you buy them? When did you close them? Things like that. Little more data so you can go do some digging. And that's where it helps to belong to a group like this, because now you're your own network of passive investors, and you can kind of, shall we say, talk to each other about the performance of these deals and the how well these sponsors communicate. Do you trust them, etc. On the sponsor, meaning the person who is actually running the deal after it closes.
Yeah, that's a great point. So, you said a lot there. So let's unpack that a little bit. Number one is relevant track record, right? Experience. Because I flipped 20 houses, I've been doing single family houses for 20 years. That doesn't automatically make you a great real estate operator. We've seen a bunch of not so great operators get culled by all this interest rate hike and COVID, and it really made a lot of the not so good operators be exposed and disappear as well. The other thing that you said, besides track, and shout out to Mr. Ryan Humes. He's a pilot for Delta Airlines. He said a strong, diverse team.
Nice.
That is very important. So yes, he's absolutely right there. The other thing that you said about, you said something about experience. You said skin in the game. What do you mean by that?
Do you have money invested in the deal after it closes, after you've taken your acquisition fee? So if you're putting $50,000,
right, the sponsor
they
have their own money in the deal.
Correct.
Net of acquisitions fees and
correct. After taking that acquisition fee. And when I say the sponsor, I'm always referring to the person who is with you when the deal closes for the next 5 years or 6 years, throughout the full life cycle of the deal, who's doing the management of the operations of the deal, and therefore with you till the deal closes. Again, it sells and gives all your money back. Who is that person? The person operating, the sponsor or operator who's running the deal. Do they have any skin in the game? Are they vested in the success of the deal in a financial sense or not?
Yeah, I agree. I won't even do a deal unless the sponsor has at least 5 to 10% of the equity required in the deal. I want to know that they have skin in the game. They have money to lose as well, right? And that is an important thing because it creates a strong alignment of interest, right?
So your lender is typically required. Your lender itself has a requirement where you'll need to put 5 or 10% of your money in the deal. I'm talking about every individual. Let's say it's, person A, B, and C are your main sponsors after closing. How much money does A have in the deal, B have in the deal, or C? Because what typically happens is you're acquiring a huge deal for $30, $40 million. Typically, most of us don't have that net worth. So we get somebody who's a guarantor, who's got a very high net worth to come and sign these loans for us. And they usually want some tax credit, tax write-offs. So they'll come in and invest $500,000 or $1 million in the deal. But the rest of us might only be putting in 50 or 100K. But then if the rest of us take an acquisition fee that's 100 or 200K, well, then we don't really have skin in the game. Only that one big guarantor has skin in the game. So I want to know every sponsor, how much invested money they have in the deal.
How forthcoming are sponsors? Like if you're a $50,000 investor and you're like, hey, look, I'm this guy that's going to, invest the minimum amount of capital in your deal, but I'm asking for the world in terms of, hey, I want to know about how much each of you are putting. I want to know X, Y, Z. How likely is it that a sponsor is going to be forthcoming with information, or are they?
Well, and if they don't, you can walk away. You have a choice. And so my point on that is they're going to know everything about you. So let's say I'm a passive investor. You're going to know how much money I'm putting in the deal. You're going to probably know my EIN or my social security number. You're going to know where I live. You're going to know a ton of stuff about me just from that paperwork. Why can't I know how much money you're putting in the deal? That's a fair question. Who else is your team member? How much money are they putting in the deal? I will ask that question. You might not answer it, but I'm going to ask the question.
Very good. And then the other thing that you mentioned, and I completely agree because this is something that I look at, is getting investor testimonials, right?
Mm-hmm.
From other people that have invested in those deals. And if you ask that sponsor, hey, give me 3, 4, 5 investors that have invested in your deal, right?
They might ask for the best ones. They might only show you the best ones, but usually sponsors like to brag about the deals they have. So I have 500 gazillion deals. Here's a list. Okay, can you give me a sponsor from these 3, an investor from these 3 deals? Especially the ones they acquired in the last 2 years, I'm going to ask. Because if they acquired something before 2015, 2020, and all of that, and sold it by 2021, which was the peak of the market, they probably did well.
Yeah.
So I'm more concerned about the deals they acquired in the last 2 years. How are they doing? What would an LP truly tell me? LP meaning limited partner, tell me about those deals. How they are performing. Are they making distributions? Things like that.
Yeah.
And why or why not? Or what does it look like the future for such a deal if you're on a floating rate bridge loan?
Very good. Yeah. All right. That's awesome. All right. So next point. I mean, let me ask this. Like, without mentioning any names, I mean, we've seen sponsors that have had capital calls. We've seen sponsors that have had foreclosures.
Mm-hmm.
We've seen all kinds of stuff happening. But a lot of times, a sponsor like this that has this distress, hey, I got a foreclosure going on. I got a capital call going on. They're not going to necessarily be broadcasting it to the world that, hey, look, I got bad stuff happening. But at the same time, they're still going and doing another deal. I mean, as a passive investor, like, how are you supposed to know or how are you supposed to know, right? Like, oh, well, these guys look really good on social media. They have a really nice website. They have X, Y, and Z. They look good on paper. They sound good. Their presentation materials look really convincing. But at the same time, there's some, negative things happening in the background that's running, but that's not listed on any website, right? That's not listed in a newspaper somewhere. How do we figure that out? Right? Like, how do we gain some insight into what's going on in the company? And is there a way to do that?
I always recommend doing a background check as a basic check from fraudulent activity, SEC violations, things like that in the past year to 10 years, etc. It shows up their history of bankruptcy. But on the shorter term, to figure out, are they really people who have the same values as me? Can I trust them, etc.? I ask the question. Here's a DocuSign document. Have you ever made a capital call? Have you ever had a foreclosure? Would you sign a statement to that effect? Would you sign an affidavit to that effect? And I would sign it for you. If you ask me today, have I had a capital call? I'm going to say no. And you say, prove it. I will sign it. Right? And so it doesn't mean I won't have one in the future, but so far I haven't. So as of today, I can tell you that, right? So it's the same thing with foreclosure. Is your deal distressed enough that it is at risk of foreclosure? Have you ever made a capital call? Those are fair questions to ask. And if you send that in writing and they reply to you no, then because verbally is one thing which you can record. Certainly you should record, but then in writing. Ask those questions direct to them. How do they respond? Are they honest? Are they looking you in the eye? That's a good clue. The other one is, again, people love to have a resume that says, I've got $1 billion of assets under management, or whatever it is, right? 500 billion, 200 billion, whatever that number is. Okay, show me a list of deals. How many doors and how many million was that? Oh, how did this deal do? Oh, it looks like you got a deal, portfolio in Houston, let's say, or portfolio in wherever, Phoenix, etc., whatever location, right? How did that do? How is that doing? Can I talk to an LP in that investment particularly? And all I will ask is, how is the performance? I'm not going to take up 45 minutes of a passive investor's time, but can we exchange an email where it says, I am, Sandhya Seshadri, an actual investor in deal XYZ, and this is the actual performance. That's it. Something as simple as that. But sometimes you have to go to that level. And that's why you want to leave it to somebody like Dr. Jonny Walker, who's going and doing all the vetting for you. Because people look perfect on social media. So how do you know that this brain surgeon hasn't had prior history of, mistakes, right? So you want to look up reviews and things like that too.
Very good, very good. So we had a question from Dr. Prezioso. He said, "Do you put that info in the PPM?" Which information were you talking about, Anthony? Was it were you talking about capital calls and things like that? I don't think that would go in the PPM.
No,
that specific deal, right? The PPM is more to talk about one specific deal, so it's not really relevant to put anything previous.
Yeah, they will not put any of that. You have to ask that question separately. Yeah. But in the PPM, you'll see names of all the managers of that LLC. So you may only be talking to person A, but then there's B, C, and D also signing the loan and part of the manager. So you want to know who that person B, C, and D are, and what is their experience and background and skin in the game and all that.
Okay, so he's saying in his question that do you put the money invested by the sponsor?
Nope. No, they don't, because that could change too. Yeah. They may initially think I'm going to put 50K, but 90 days later when they're closing, it might be like, oh, our proceeds are less. I got to put more money. Or no, I got to an investor who really needs to invest extra money in the deal. So I'm going to reduce my portion in the deal, etc. And the same with the loan terms. Today's webinar might give you one number, but 3 days prior to closing, that could change. So when it gets near closing, you want to ask them, what has changed since you presented the webinar to me?
Mhm.
That's a good question to ask because a lot of things can change depending on how long it's taken.
If they got to bring in another private equity firm or like,
Yeah, what have you been doing? Yeah.
Yeah.
What has changed in the capital stack that will affect me as an investor with my returns? Did you get less in loan proceeds than what they initially anticipated? So you had to bring in more capital into the deal, which means the leverage is, reduced, which means the returns are also affected by it.
Yep. Dr. Hancock says, what is PPM? So PPM,
private placement memorandum.
And what's the purpose of the PPM?
To explain to you all the terms and conditions. Like when you get a mutual fund, there's something called a prospectus that none of us ever actually read. But this basically details how the deal is being operated, what communications you can expect, and what are your rights as an investor and their rights as the general partners. And one of the main things they want to tell you that they don't really tell you is that you could lose all of your money and you will not sue them for it because things can happen and things can change. Just like when you go on that ride in Six Flags, you're signing a waiver automatically that I could die from this ride and that's okay. Whether you realize it or not, that's what you're saying.
Yep, exactly. So PPM is a really, really detailed, really deep dive. Oftentimes they're over 100 pages long. So
Easily.
Deep.
One of the things in the PPM is the operating agreement is one of the documents. There's usually 3 or 4 different documents. One of them is an investor questionnaire where they want to know how sophisticated you are and how well you're comfortable and is this your last 50K and things like that. Like you might even have to provide an accredited letter. Another one is like a subscription documents. You're agreeing to purchase, so many X shares of this particular equity, just like you're buying shares of Amazon stock and it's 1,000. So I'm buying 100 shares. So it's $100,000 as an example. And then the other one is what is called the operating agreement or company agreement. That is how this company will operate. So let's say they're acquiring, property ABC. So this is the property ABC operating agreement that tells you who are the main people running the show, what kind of fees they will be taking, what should you do when there's a challenge, who are the decision makers, voting rights, all of that lovely stuff is detailed in there. So let's say today your property is in distress, you're a surprised passive investor, this deal was acquired 2 years ago, now you want to see who else is a passive investor, how can I ask questions, what is reasonable for me to expect? All of that is outlined there, so you want to read it so that you can go back to the sponsors or the syndication attorney and ask, okay, I want full disclosure of these things.
Yeah, that makes sense. So Ivory, there's basically 4 main documents you're going to get it as a passive investor. Sunday outlined them here. There's a questionnaire, a operating agreement that you would sign. There's a PPM, the private placement memorandum, and
subscription documents that say how many shares and how much it is,
how much you're going to invest, socials, security number, etc. Yeah, great. That's great information, Sandia. All right, so let's talk one more criteria today, and then we'll wrap it up for today, Sandia. I know it's been going a little long. We're going to do one more top criteria to consider when picking a sponsor in a passive investment.
So one of the things we said previously was also assumptions. So don't forget to ask that. So you got track record, you got assumptions, you got skin in the game, you've got the team itself, complementary strengths and skills and all that. I recommend running a background check. Don't wait. Just run a background check. It's not even $50. If you're going to put 50,000 or more into a deal, what's $50? And you find out all these bankruptcies and things about them. To me, that's very important. And then finally, your communications. What can you expect? What have they done before? Can they share an example of a past investor report? Their level of transparency. Can I have full access to financials? Will you share with me monthly bank statements so I know what's happening in all accounts, not just the operating account? They have a different account for capital, things like that. So transparency and communications as well as financials, because even if you don't say a whole lot in your report, if I look at your numbers, I know exactly where you're headed. That's important to me.
Yeah, no, that's fair enough. Yeah, that's absolutely wonderful. So, you guys, we're gonna we're not gonna keep going, but this conversation could continue on for hours, right? Like there's a lot of different things to consider as a sponsor, and that's just on the sponsor due diligence, right? That's all the stuff we're talking about is just due diligence on the sponsor. We haven't even talked about the due diligence on the property itself, right? So there's very detailed levels of insight and questions that you want to ask if you want to really invest at the highest level, right? Like if you want to invest and try to. Because with these type of passive investments, you have the ability to de-risk deals, right? You can never eliminate risk, but what you can do is really try to stack the odds in your favor that there's a higher chance that this deal is going to be successful, right? There's a higher predictability of outcome, and that's going to come down to the quality of the due diligence that you do. Sandhya, I want to thank you so much for being here again and taking some time out of your day to chat with our group. I know the people that have already responded have shown a lot of like, hey, look, this is amazing. And so I really thank you for being here. Any last parting words before we close it up here?
Don't let fear stop you from investing in real estate, because you know what? I know you're not doing even 1/10 of this diligence when you blindly put money into your mutual fund. So think of real estate as illiquid and long-term and give it the time it deserves. Don't be worried about day-to-day things happening in a property. Look for trends and keep it in the long horizon of 5 to 7 years. Don't expect miracles to happen overnight. This is not a lucky stock pick.
All right, guys, there you have it.
Thank you.